Now let's get a look at the bigger picture. Anthony Saccaro is with us, President, Providence Financial and Insurance Services. Thank you for being with us. We just went over some of the data from today. Did anything in particular stand out to you?
Well, it really all boils down to inflation. I think that's the number one thing that is on the Fed's mind. That's the number one thing that's on consumers' mind is things are costing more than they were a year ago and certainly more than they were a couple of years ago. And it's that really that is driving what the Federal Reserve is going to do. A year ago, I think, when at the beginning of the year, actually, the Federal Reserve was going to lower interest rates 6 or 7 times. That was kind of what their goal was. Now it's down to like 1 or 2 times. And so it's kept dwindling. But they have to have a reason to lower rates. Inflation is softening. The labor market is softening. And it's looking like they'll lower rates sometime in maybe Q4. But it's really a question as to when. Are they going to do it closer to September or closer to maybe December? And I think there's still an argument that they don't lower rates at all. But I think that's not probable.
Right. Okay. So you do see some sort of rate cut coming. You just don't know whether it's September, November, December. September is 65%. November is 77% likelihood when you look at Fed funds futures. And December, 93%, which is slightly lower than it had been for December. And then they talk about the new year to see more cuts. Maybe you get one in this fourth quarter. And then in the new year, what? More cuts?
Yeah, well, I mean, the economy is weakening for sure. GDP is slower than it was in Q4 of last year. Inflation is going up a little bit. The CPI numbers were a little softer. The PCE numbers were a little softer. The labor market's weakening right now. There's a 4% unemployment rate. It was 3.7% at the beginning of the year, so that's gone up a little bit. And it's all driven by the labor. If you were going to ask me, what is the number one thing that is driving this? It's really the labor market. The fact that there's still 1.3 jobs available for every worker that's out there. But even that's come down. 2 years ago, 2.5 years ago, it was almost a 2-to-1 ratio, 2 jobs available for a worker. So everything is going in the right direction. But it's not there yet. What the Federal Reserve has to do, though, is they have to be proactive, not reactive. This was the problem when COVID happened and the Federal Reserve said, no, inflation is going to be transitory, and they didn't do anything. They weren't proactive. And from a reactive standpoint, they lost a lot of ground. Well, they can't do that again. Inflation is a lagging indicator, so they have to lower rates before the inflation actually hits. So we don't want to wait till inflation gets down to their 2% target for them to do anything, and it looks like they're not going to do that. So again, I think the third quarter, fourth quarter of this year, and definitely some in the next year is certainly going to bring us more rate cuts. And we're still not out of the woods with regards to a recession either. So that's something that the consumers and investors have to keep in mind.
I'd love to hear more about the investment strategy you talk about, particularly for retirees, whether you're doing that ahead of time if you're 30 or 40, or if you're 60 or 70 or 80. What's some of your advice these days based on the current market environment?
Yeah, if you're younger, I think you keep dollar cost averaging, keep buying the same mutual funds or stocks over and over again. If you've got 10 or more years of retirement, that's a great strategy. If the market goes down, you win because of the fact that you get to buy more shares for your same investment. When it comes back, you're going to have more shares. Just keep doing what you're doing over the long run. When you're retired, though, or close to retirement, if you're going to be retiring in a few years or you're newly retired, well, the market's at near record highs. And it may be some time to take some chips off the table and start focusing more on income, things that are going to give you interest and dividends. And I think that would be the focus. The interest and dividends are the bird in the hand, whereas the growth is something that you can't necessarily count on. So if you're retired, I want you to know that you have something that's going to, be able to give you some income. I think that's the better approach. Oh, and by the way, these income producing strategies happen to be more conservative too. So you kind of kill 2 birds with 1 stone.
Yeah. When you think about Mag 7 and that kind of, growth strategy, do you like some of those names?
So the Mag 7 has been a lot of what's held up the entire economy and why the stock market is at record highs, right? Because of the Mag 7. You take the Mag 7 out and we don't have nearly the performance that we've had before. If you're a growth-oriented investor and you have time, or even if you're retired and you've got some money that you can set aside and throw into the Mag 7, I don't think it's a bad time to do that. But it really depends on your strategy. You have to have the money to be able to do that, to set it aside, to not need income on it. You've got to give yourself a 10-year time horizon. The last 12 years in the market's been up 15% plus a year. The next 10 years or 12 years is probably not going to be the same thing. And when the market tanks, when we go into a correction or we go into a recession, as is likely to happen sometime, I mean, we're going to have another one at some point. When that happens, the Mag 7 may very well lead the way down, just like small caps may very well lead the way down. So you want to be careful. You want to know that whatever you put in the Mag 7, yes, you've got a lot of potential for growth, but you've probably got a little more risk than maybe you want as well too. You have to have at least a 10-year time frame in my game if you're gonna put in the Mag 7.
Are you worried about, I don't want to say recession or hard landing, but, we keep hearing a little bit about a pullback, a 10% or 30% pullback, and those would be buy the dip opportunities. Are you thinking it could be something different? Are you worried about a black swan event, things like that?
Well, we could always have a black swan event. The whole point of the black swan event is you don't know what it's going to be, right? There's a couple of things out there that could be the black swans. It could be another variation of COVID, although I don't think so. I think we're out of the woods there. I think, all the vaccines and people, I think people are over that. So I don't think that's a huge, but geopolitical is what bothers me the most. We've got a lot of terrorist things going on outside this country, right? I think there was a report just recently of a lot of people killed. There's wars going on. What if we have another terrorist attack in this country? That's not out of the question. That could be something that spooks the market in a big way. That's what happened when we had 9/11. So that, I think, is the biggest risk. But here's the key. If you're invested right, it shouldn't matter. And if you're retired and you're focused on income, then it doesn't matter because you've locked in interest and dividends. You've locked in income from your portfolio that you can count on no matter what happens. Doesn't matter who wins the election. It doesn't matter what wars are going on or what other geopolitical. If you have interest in dividends and you do it right, you can focus on your income. And the same thing, if you're a little younger and you're in the accumulation phase of life, you can still add in dollar cost average. It doesn't matter. You should be in a position to win no matter what happens to the market. But yeah, I have some concerns, but if you're invested right, those concerns shouldn't necessarily be valid to you. And don't panic. If we do have a 20 or 30% correction or worse in the market, that's happened twice in the last 25 years. The worst thing you can do is panic. No good decisions happen when you panic. The time to make a plan is when the market's at record highs. That's where we are. Make a plan, stick to it, and make sure that your plan allows you to win no matter what the market does.
Anthony Saccaro, thank you so much. Great to see you. Providence Financial and Insurance Services. Thank you, Anthony.